Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're digging into UniFirst, ticker UNF, and this one is a real head-scratcher. The stock just cratered, hitting a 52-week low right after they, get this, beat their earnings estimates. So we're going to figure out what in the world happened.
All right, let's get right into the central mystery here, right? How does a company beat expectations and then see its stock just fall off a cliff? Well, on the surface, everything looked pretty good. But the market, it heard something else entirely. This is one of those classic stories where the past looks great, but the future, well, that's what has everyone so spooked.
Okay, so first things first, let's just look at the part that actually looked good. The numbers for the quarter they just wrapped up. On paper, it was totally solid.
And here you go. They absolutely cleared the bar. Look at that adjusted EPS, $2.28 when Wall Street was only looking for about $2.15. That's a nice beat. Revenue also came in a little bit higher than expected. I mean, for a company like UniFirst, which is kind of known for being this steady, predictable business, these are exactly the kind of solid, dependable numbers you'd normally want to see.
But the market had other ideas. I mean, look at this, an 11% drop, a new 52-week low. That's not just a little dip, that's a full-blown panic sell-off. So you have to ask yourself, what on earth did investors hear that made them react like this? Well, you guessed it, it had nothing to do with the quarter that just happened and everything to do with what's coming next.
Yep, this is where the wheels completely came off the bus. It wasn't the results, it was all about the guidance. The forecast for the year ahead was the poison pill buried in this report.
And whoa, here it is. Now the revenue guidance, okay, it's a little light, but it's not a disaster. But the earnings forecast? Oh man, just look at that difference. Wall Street was expecting something in the ballpark of $8.60, $8.70 per share, but management comes out and guides to a range that tops out under $7. That is nearly a $2 miss at the midpoint. That's not a small adjustment, folks. That is a massive, fundamental reset of expectations for the entire year.
So the big question is, why? Why is profitability about to fall off a cliff? Well, to their credit, management didn't really hide from it. On the call, they pointed to 4 big reasons.
It's really kind of like a perfect storm of headwinds hitting all at once. First, they've got this big new Oracle tech system they're rolling out, and that comes with a lot of upfront accounting costs. Second, a really profitable project they had in their nuclear services business is ending, so that chunk of high-margin profit is just gone. Third, and this one is on purpose, they're spending a lot more money on their sales teams, trying to invest for growth down the line. And finally, you've got tariffs making their products more expensive. So you see, it's a mix of things, some temporary, some strategic, but all of them are squeezing profits right now.
And this is really what it all boils down to. It's management story versus the market's instant reaction. You've got 2 completely different ways of looking at the exact same information, all based on the timeline.
So you've got management on one side saying, hey, look, this is a transitional year. We're making investments now that are going to pay off big time down the road. They're playing the long game. But then you have the market on the other side, and Wall Street is pretty much always focused on the next quarter or two, and all they see is a massive cut to earnings and a whole lot of uncertainty. It's that classic clash between long-term strategy and short-term pain.
Okay, so with all that in mind, what's our take? Where does the stock go from here, and what should we be looking for? All right, here's our verdict. For the next quarter, we expect their results to come in right where management guided. They've lowered the bar pretty significantly, so they should be able to clear it. As for the stock price, it's probably going to be stuck in the mud for a while. The market is now in full-on prove-it mode. They're not going to give UniFirst the benefit of the doubt anymore. Which brings us to our official Talk Tickers rating. We're calling it an underperform. The entire story for this stock has changed. This isn't a sleepy, stable company right now. It's a turnaround story. And until management can prove with actual results that these investments are working, the stock is likely going to lag.
And as always, remember, this is not financial advice.